In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Hi, and welcome into Eye on Retirement, a product of Market Advisory Group. It's the weekly show that keeps you in the know about all things retirement. I'm Rick Everett, along with Financial Advisor Jonathon McCoy with Market Advisory Group. Jonathan, welcome in.
Thanks for having me, Rick. Very excited to be here.
We've got a lot to cover in this show, and I'm going to start right off with asking some questions about Social Security. Jonathan, should someone file for their Social Security as early as possible?
Well, we hear a lot of misconceptions around Social Security and timing strategies in particular. One of the more popular educational classes that we do around the metro areas that we work in is specifically on Social Security. And oftentimes we have people telling us, I talked to my neighbor, they filed as early as possible. I talked to my coworker or a family member or a friend. And ultimately you have to understand that your financial situation is likely different from your neighbor or your coworker or your family, even if you've worked 30 years side by side at a desk or a workstation next to the same person doing the same job. You never know what their financial situation has been, whether they've paid off debt sooner than you, or maybe they've got a spouse who's maybe saved a little bit more money. And the amount of money you have saved doesn't necessarily determine that either, but the importance that we like to put on it here at Market Advisory Group is looking at hypothetical outcomes of different filing strategies. So if you filed as early as you could, say at age 60 if you're a widow, or age 62 if you're filing on your own benefit or on a spouse's benefit, it's important to test the outcome of that decision before you make the decision. So filing at 62, 65, 66, full retirement age, maybe as late as 67 for some people these days, or all the way as late as age 70. Testing the different strategies ahead of time is really the key to our process.
So when somebody comes into Market Advisory Group and receives their complimentary consultation as far as retirement goes, are you able to lay out all the different scenarios for them as far as they pertain to filing for Social Security, what it would look like if they filed at age 65, what it would look like if they filed at age 72?
Yeah, that's one of the first steps in our process is understanding, okay, especially if you've not filed for Social Security yet, it's very straightforward for us to be able to test the level of income that you're going to be receiving from Social Security and then compare that to how much income are you going to need as a whole, which builds into how much income are you going to need to supplement that from your retirement accounts, which then connects the dot to what type of investment strategies are appropriate, how much risk should be taken on different pots of money throughout the rest of your retirement. All of these decisions are connected, but it starts with a few simple things like, what is your Social Security benefit going to be? We get so many common questions though on what am I even eligible for on Social Security. If you've been married, I mentioned before, if you're a widow, if you've lost a spouse in the past, you may be eligible for additional benefits that doesn't necessarily apply to the typical person who's either been married or single their entire life.
So should a person consider waiting until as late as possible, or is it like you stated prior that everybody's financial plan is as unique as their own fingerprint?
I would go with the latter as being the more appropriate answer, because it's just like the filing as early as possible. It's not necessarily the best answer, but we know that waiting to file until age 70 oftentimes is costing people potentially years of retirement or time in retirement. So if you're feeling like you're forced to work until age 70 to get that maximum benefit, you have to understand what sacrifices are going on there, the years and the time that you're never going to get back. But on the flip side, if you're going to need that maximum benefit at age 70, then you don't want to necessarily pull the trigger too early, especially if you've got a younger spouse who may benefit from that higher Social Security amount. And there's a lot of different situations that can come up there.
Jonathan, I'm going to throw a scenario at you and let you field the question. It's a hypothetical.
Okay.
Let's say I'm divorced and I was the higher earning spouse. Can my ex get my benefit?
Well, there's a few rules that your ex would have to follow. Number one is you would have had to have been married for at least 10 years. So if you're married for more than 10 years and you divorce, your ex-spouse can file for benefits on your record. And while you're alive, they're eligible to receive, depending on when they file, relative to their full retirement age, they're eligible to receive up to half of your benefit amount. Now, if you were to pass away or predecease your former spouse, they are eligible then for widows or surviving spousal benefits, which you can research a lot of information on that online as far as how that works, becoming eligible at age 60. If you pass away before your former spouse turns age 60, they're eligible as early as age 60. But if you're still alive, still healthy, and you could have 3 former spouses and have been married 3 times for more than 10 years. Now, it's a lot of different marriages over a 30-plus year period. Each one of those former spouses would actually be eligible for that same half benefit on your record as a former spouse or as a divorced spouse. So the answer is yes. But the question is then, if you remarry, what are your options? Can you file as well on your former spouse's benefits if you weren't the higher earning spouse? Those are some common questions that we have to go through, and it's really pretty simple to answer those questions. We've got a group of professionals that we work with as well that have been associated with the Social Security Administration in the past. I mean, we can really dive deep into the exact rules and how they apply to your situation.
So if a person remarries then, is that former spouse still able to lay claim to a portion of the Social Security?
As long as they meet that 10-year rule that you were married to your former spouse for at least 10 years, the answer in most circumstances is yes.
Okay. Now, what are the tax rules? Do they vary as far as the taxation of the Social Security, depending on what percentage you're getting or if you're getting full percentage?
Mm-hmm. So it's correlated with how much income are you receiving from outside of your Social Security benefits. So let's take that example of if you have remarried, there's a scale that the IRS and the Social Security Administration use to calculate how much of your Social Security benefit is actually counted as taxable income. We don't have anywhere near enough time to go through that. Just to give you an idea, our CPAs walked me through this 33-page booklet that the IRS puts out to help calculate how much of your Social Security is counted as taxable income. So if it took the IRS and a group of experts 33 pages to explain it, it's probably a little difficult to explain here on the air. But the answer is there is a specific set of rules, and the calculation of that factor changes depending on whether you are single or married.
You saw a client recently that had a situation involving the maximum survivor's benefit. And I wondered if you'd share that with our viewers.
Yeah, so this gentleman was 60, and this is kind of the root of some of these common questions around should I file as early as possible. He had decided that he was going to wait until he was 70, but he had enough saved. He felt comfortable retiring at 60, waiting for his Social Security benefit to roll up to his maximum benefit at age 70, so that his wife, who had not worked for a number of years, she had worked at home raising the children, so didn't have as much of that Social Security earnings record to contribute. So he wanted to get her the highest survivor's benefit, considering he was about 12 years older than her as well. So the likelihood of her outliving him by potentially 17, 20, 25 years, we ran these different projections. And ultimately for him, even though he was rock solid locked into waiting until he was age 70 to get her that highest benefit, when we ran some various calculations of his life expectancy, we gave him age 85 as an example. Taking Social Security earlier actually helped sustain the amount of savings that he had in his 401k and IRA assets over a much longer period of time, giving them compound interest growth, so on and so forth. So we ran these calculations ahead of time and determined that it would actually leave his wife with potentially $200,000 to $250,000 more over her lifespan had he filed at age 62, as opposed to waiting until age 70. Now, these numbers work out in various different situations very differently. So what we encourage people to do is actually sign up, as we talk about in every episode, for a one-on-one complimentary consultation. If you come into our offices, first you'll want to reach out at 316-252-8707. Get a hold of our operators. They'll get you set up with a one-on-one consultation. You can meet with me or any of our other financial advisors in our office, meet with our tax team, our estate planning professionals, or our Medicare advisors, depending on where your questions lead us. You can also reach out to us at ionretirement.com and submit your questions. If you submit a question and include your physical mailing address, we'll be happy to send you one of our Ion Retirement coffee mugs here. Those are a nice addition to the kitchen at home. So again, that number is 316-252-8707. And those complimentary consultations are available to anyone, anytime, with any questions that you have. We just want to be able to help.
And also, as you're watching and wondering if you can catch past episodes of Eye on Retirement, the answer is yes. You can go to our website at eyeonretirement.com and catch all our prior episodes. We'll be right back after this.
When people work with Market Advisor Group, they get a feel of sense of family. There's a lot of relationships that are made and going on in this conference room, and we really take a lot of pride in that and a lot of satisfaction in that.
Every client we work with, we make a custom-made plan to fit them and help reach their goals in life. And then another thing that makes us unique is we want to meet quarterly with our clients and have reviews.
Market Advisory Group, we have a process, and the process we take people through is first to understand what they have, understand who they are, and then we put together an income plan for them and show them how they can look forward to retirement and not look, though retirement is going to be a stressful time. It needs to be a stress-free time.
A few unique features of working with Market Advisor Group is holistic in-house financial consultants. We've got an in-house CPA, Joshua, an in-house estate planning attorney, Gerald, an in-house Medicare advisor, Bill. We rely on all of those professionals for, again, additional service within our consultative process, making sure that we've got the advice and the expertise behind the recommendations that we make.
You know, as an advisor, I'm not there to sell them one way or the other. I'm there to educate them, to let them know what their choices are. Then I try to help them make the right choice where they can save money and feel confident in their decision.
Absolutely the best part of my job is getting a stack of paperwork from somebody and they don't know what to do, and then I can turn around and give them back a tax return, but also to be able to explain what they can do next year that will give them a better answer than what they had this year.
When we've got clients that are calling and they need to help out a child or need to help out a grandchild or need to help themselves out and they're in a situation they didn't expect to be in, I really relish the opportunity to help them through that, help them make the educated decisions in somewhat stressful situations, because a lot of folks don't have that type of counsel.
We meet with so many people one-on-one in this office that don't ever end up becoming a customer or doing business with us, and that's okay. But when they leave our office, we know that we've helped them either get some answers to some of the questions they had or get some clarity on maybe their own path.
But one of the things that we hear all the time is, I wish I would have met you guys 10 years ago, because how much further could I be down the road? Well, Johnny Appleseed said, when's the best time to plant a tree? 10 years ago. When's the second best time? Today. And so if we can help people today going forward, that just brings an incredible amount of comfort and excitement for us to come to work every day.
Welcome back to Eye on Retirement, a product of Market Advisory Group. I'm Rick Everett, along with Financial Advisor Jonathon McCoy. And in this segment, I want to talk about planning. We know what investment planning is. It's our roadmap as to how we want to invest. We know what tax planning is. We want to prepare for our taxes in advance so we're not caught by surprise.
At least we hope we are planning in advance, right?
We hope.
Yeah.
However, what is income planning? I've heard the term, but income planning?
Well, it's in a way, there are certain aspects that are the opposite of investment planning. So while you're working, investment planning involves, okay, here's how much risk reward you want in your 401k. You're contributing every week or every month, whenever your pay period is, trying to determine how much money you can pack into that asset over your working career. Well, income planning ultimately is the exact opposite. How much income is it safe for you to be able to pull off of your portfolio based on A, what your lifestyle is going to require, but B, it does get back to being very closely related with how much risk you're taking in your portfolio. So if you've got an investment, for example, that you're pulling, say you've got $100,000 and you're pulling $4,000 a year out of it. So that's the old school 4% rule, right? That a lot of big financial firms will run by. It doesn't work for everyone, but by using that math, if you're pulling $4,000 a year out, and that account value drops by 50%, Now you've got $50,000 that you're pulling $4,000 a year from. Now you're running by the 8% rule, and it becomes much more difficult for that asset or that investment to recover in value. So income planning really has all the similar ingredients as investment planning in general, but it's got to be focused more around what your lifestyle is going to require and addressing the issue that if the market goes through a major downturn, are you going to be able to sustain your lifestyle, or are you going to have to stop or put off some of the things that you retired to do? And in our terms, that is, you're losing time, right? Ultimately, if you sit on the sidelines, not doing anything, not spending any money that you worked so hard to save simply because the market decides to go through a downturn, you have lost time. You may not have lost money in the long run, but you will have lost time.
It's not my idea of an ideal retirement.
Not a comfortable one anyway, yeah.
How does your withdrawal rate then affect how you invest in retirement?
Well, that depends. It depends somewhat on what your investment strategy and what sort of advice you're actually getting really is leading you to. If you're investing openly in the stock market, I meet with plenty of people that are sort of do-it-yourselfers, and they're picking and choosing stocks, or they've picked an index and they're just going to let it ride. Well, ultimately what we're trying to test here at Market Advisor Group is how much pain or how much loss can you sustain living on that same level of income that you've come to be accustomed with when you retire. So really what we're looking at is how much risk should be taken on different periods of money that represent periods of time in your life. So if you've got, let's use $1 million. Not everyone has $1 million in a retirement nest egg, but if you're going to spend $250,000 out of your retirement account in the first 10 years, so $25,000 a year, it may make sense to have that $25,000 a year to get you through maybe a 5 to 7 to 10 year market downturn, still knowing that you can pull income from that investment or pull income from that account, all the while leaving the rest of the nest egg. In this example, the other 3/4 or $750,000 can go through a little bit more of the ups and downs because you're not relying on that portion of your nest egg for income.
It's a cushion, if you will.
And yeah, and there's no exact science to this. And the way that we build those plans for folks at Market Advisor Group, it's different from one person to the next. But we find this time-related allocation based on how soon are you using the money and how much are you spending to help determine how much risk you're taking. It's a pretty surefire way to at least give people a big picture of how they should be managing their money.
I assume that retirement is a lot like any other thing in life. Once you've been doing it for a while, it becomes a little bit easier. But how does a person determine what they'll need for, say, the first 3 to 5 years of retirement?
Well, sometimes it's educated guessing, but what we like to do is dig in deeper into what is going to be changing in your lifestyle and your income needs. So if you're going to be paying off a house, if you're going to be taking on maybe some new debt, getting a vacation home, buying a new car, putting kids or grandkids through college, those are all things that we've got clients today that are retired with those expenses. So we know it's possible. We know it's sustainable depending on what your assets and resources are. So really the process is the same for us with everyone, but the outcome is always going to be different because everyone's needs are different. But getting back to what I think the root of your question is, 3 to 5 years before you retire, how are you going to know what your lifestyle in retirement is going to cost? Sometimes it really just does take digging into your financial situation. And we in our complimentary consultation process, what we're looking at is looking specifically at the things that will change around the time that you retire to help determine how much income you're going to need. That's something that we guide people through in the consultations.
If the market were, if we had that guarantee that the market were going to continue to go up or at least maintain, that would be one thing. But what if the market drops and stays down for a long period of time?
Well, it's something we've not experienced for quite a long time. And we talk to people today that say, I've been with my financial advisor for 15 years and overall been very, very happy with them. Well, I've been very happy with a lot of different financial advisors over the last 13 years as the market has continued to go straight up. So sometimes it takes a bit of a reminder that you're not guaranteed these 10 to 15% per year rates of return for all of your years of retirement. And ultimately what we're looking at is dissecting your existing portfolio and starting to make comparisons to here's how we do it for our clients. Here's how our clients are expecting to survive the next market downturn based on a proactive plan that is put in place ahead of time. And to get an idea of what those plans look like and what it could look like for you, just reach out to us at our phone number at 316-252-8707. You can also reach out to us on ionretirement.com. You can ask us questions there. If you send in a question, be sure to include your physical mailing address. We will not spam mail you, but we will send you one of our complimentary Ion Retirement mugs. But if you call our number, once again, 316-252-8707, our operators are standing by. They'll take your call. They'll set you up with a one-on-one consultation to sit down with our financial advisors, our tax planning team, our estate planning team, our Medicare team, any one of those professionals that you may see beneficial to sit down with to get your questions answered. We're happy to sit down with you as soon as possible.
He's Jonathon McCoy. I'm Rick Everett. The show is Ion Retirement, and it'll be back right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Hi, and welcome back into Ion Retirement. The phone number, 316-252-8707. If you'd like to call in at any time during the course of the show and set up a complimentary consultation with one of our advisors, we invite you to do so. Jonathon, we were talking in our last segment a little bit about how to plan and how to look at the first 3 to 5 years of retirement. We talked right before we went to the break about what if the market drops and it stays down for a long time. Pulling money from an account with losses can actually, I would guess, be a pretty devastating thing to a person's portfolio.
Yeah, that's one of the main reasons we saw so many people having to look to go back to work during the 2008 financial crisis, when the market dropped over an 18-month period of time and then took, in many portfolios cases, 4 to 6 years to recover, to get back to even. So all of that time lost, all of that money lost, if you were already retired and having to live off of assets that are invested in the market, it can take much longer if you're pulling money out, as opposed to when you're contributing. If you're working and the market drops and you're still putting money in, it actually can be a good thing, because you're buying the market, you're buying those shares at a lower average cost. It's called dollar cost averaging. Well, that dollar cost averaging sort of works in reverse when you've retired, where your investment returns are going to be significantly reduced, because during a market downturn, we talked a little bit in the previous segment about the concept of the 4% rule. While it's not hard and fast and it doesn't work for everyone, if you're pulling 4% of your portfolio out and your portfolio loses half of its value, are you going to be able to completely shut off your lifestyle and shut off your expenses that were taken care of by those withdrawals, or are you going to have to still take out that same cash value? So while the 4% rule and some of these other general rules of thumb might sound good, you're pulling that money out, your account value drops by even 30%. That means every withdrawal you take is having a 30% larger negative impact on the long run performance of your portfolio. So we've got to be looking at different ways to position people's money to use different pockets of money during different market periods and have that more proactive strategy in place.
You know, you've mentioned that 4% rule now twice in this show, and some firms use the 4% rule, or some people who are investing just plan on getting 75% of their working income. A person can take that and wonder, are there any general rules that are surefire per se?
Ultimately, no. And give you an example. A gentleman came in, 65 years old. His age didn't have much to do with it, but that was the determining year where he was going to be able to get Medicare and switch over to Medicare, and that was the main difference maker in what he thought would get him to an affordable lifestyle in retirement without having to work for a paycheck anymore. So we sat down and we look at the cost of the Medicare, we look at the overall cost of his lifestyle. He was still making a house payment and other things like that. And he had been told, in this case, not the 4% rule, but this 75% concept that you should be able to live on 75% of your normal income from work in retirement. Well, we went through the math, and ultimately he was going to need closer to around 90% of what he was making at work in order to survive. And a big part of that was some of the debt that he was trying to take care of. And it's not impossible to retire with debt. It's a little more difficult, but not impossible. We've got a number of people that we work with today that are working through and paying down debt, especially home mortgages and things like that. So it's so personalized that I think these general rules that are thrown out there that you can read in online articles, it's very easy advice to get, but it's very difficult advice to implement. When you get into retirement and you say, okay, I should be good on 75%, and you realize you're coming up $1,000 a month short every month, then apparently the 75% rule or the 4% rule or whatever you're trying to run or base your retirement on, apparently it's not actually enough. So we've got to look more detailed at what your budget is going to look like. And that's what you asked about in the first segment, is how do you determine what your lifestyle is going to cost in retirement? Sometimes it may take a year to figure that out. So we're building that into a budget to get someone through a year to 2 years to figure out what their retirement lifestyle really is going to involve. Sometimes that's part of the retirement plan as well.
Jonathan, we've talked in the past about the difference between a commission-based investment advisor and a fee-based, and here at Market Advisory Group, we are fee-based and under the fiduciary standard. A quick question I have for you is, if somebody out there is watching and they're working with a commission-based advisor, can they still come in and see us for a complimentary consultation?
Yeah, they can. We've often met with people that their broker has just gone through earning a round of commissions, selling them the given investments that they're going to ride on for the next 2, 3, 5 years, whatever it may be. The strategies are all different, but we encourage people to call us anytime at 316-252-8707. You can also reach out on ionretirement.com to ask us questions and set up a one-on-one consultation there as well. But our operators are standing by at 316-252-8707. Set up that one-on-one consultation. We'll sit down, look at your situation. No matter where you're coming from, we can help build a plan for you.
The time has gone quickly and we're out of time on this episode, but we do encourage you to join us next week for another edition of Eye on Retirement.
This broadcast is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of foundations and its affiliates. The information contained herein does not constitute securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or is excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. Legal services are offered by Eidelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal and tax advice. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. This broadcast is copyrighted by Market Media Network. All rights reserved. Brought to you by Market Advisory Group. Invested in you. Call 316-252-8707 at 316-252-8707 or visit marketadvisorygroup.com.